Look, we are unpacking an absolutely massive shift right now. We're talking about the definitive transition of Bitcoin from a wild, retail-driven speculation vehicle to a strictly dominated institutional asset. For years, right, this space was completely defined by those crazy boom and bust cycles. But as the data we're going to dive into today proves, that era is literally in the rearview mirror. We are navigating a completely transformed landscape. So here's our roadmap for the explainer today. We'll start by looking at the institutional takeover, then see how ETF inflows are absorbing supply. After that, we'll open up the corporate Treasury playbook, unpack this brand new macro correlation, and finally, walk through some concrete family office allocation strategies. All right, let's jump right into section 1, the institutional takeover. Now, you might be wondering, is the retail-driven 4-year cycle dead? For years, this market ran on a super predictable boom and bust rhythm, mostly driven by retail sentiment and those 4-year halving events. But looking at the massive structural changes since 2024, it's pretty fascinating to ask if that old framework is just, well, obsolete. Fidelity Digital Assets actually recently published research suggesting exactly that. They noted that with all-time high market caps and seriously deepening liquidity, those historical retail-heavy cycles might just be a thing of the past. The answer to that question really lies in this massive, massive figure, over $115 billion. That is how much is now locked up in professionally managed spot Bitcoin ETFs. We're talking about serious capital here. Pension plans, major asset managers, and institutional wealth, seamlessly bypassing all those old, complex custody risks. This absolutely staggering amount of money acts as a structural price floor. And honestly, that kind of anchor simply didn't exist in any previous market cycles. You can really see the stark contrast between these two eras right here. We've moved from a pre-2024 market that was super reactionary, retail-driven, and honestly a bit of an unregulated frontier, right into a post-2024 environment that's highly predictive, led by institutional capital, and heavily supervised by clear regulatory frameworks. We're talking SEC oversight in the US and MiCA in Europe. The players have fundamentally changed, and so have the rules of the game. Moving right along to Section 2, ETF inflows absorb supply. So Fidelity Digital Assets highlights that today there's a totally new demand dynamic taking shape as institutions participate through a variety of channels. And what this looks like in the actual data is just fascinating. Even when on-chain retail demand weakens, or maybe some early holders decide to take profits and sell off, these programmatic, continuous inflows from the ETFs basically just step right in to capture that supply. They are essentially acting as the marginal price setter for the entire network now. Just look at the breakdown of ETF ownership from CoinShares Q1 2025 13F report. We can definitively prove this shift is happening right now. Investment advisors command half the market, a full 50%. Meanwhile, hedge funds, which are typically much more tactical and short-term focused, have dropped down to 32%. This rotation is absolutely critical. It shows a massive lean away from short-term speculation and a huge move toward long-term strategic rebalancing by advisors who are strictly prioritizing fiduciary management. Okay, let's pivot to Section 3, the corporate Treasury playbook. Drawing from ARK Invest's recent mid-year review, we can see a literal explosion in corporate Treasury strategies. Back in December 2024, you had 74 public companies holding about $50 billion in Bitcoin. Fast forward just a bit to mid-2025, and that number nearly doubled to 141 companies controlling a whopping $90 billion. I mean, that is an incredibly aggressive adoption curve for corporate finance in just a matter of a few months. And the crucial takeaway here is that the MicroStrategy model, it's no longer just some crazy outlier. It has become a structural corporate treasury standard. Thanks to updated fair value accounting rules, companies are now transparently holding digital assets as a core defensive posture. They're doing this to actively bypass fiat debasement and protect their balance sheets over the long haul. This brings us to Section 4, the new macro correlation. Take a look at this number, 94%. During periods of extreme liquidity stress, Bitcoin's correlation with the S&P 500 has actually spiked to 94%. Now, this completely shatters that old pure digital gold narrative, the idea that it acts purely as this totally uncorrelated safe haven in the short term. Instead, it proves that it's now trading right alongside traditional tech equities. So what has it actually become? Well, it's now a high beta macro asset. Think about it. The institutional portfolio managers trading NVIDIA, Apple, and Tesla
are the exact same people managing these Bitcoin ETF allocations today. When they de-risk, they sell everything simultaneously. Because of this, Bitcoin is now highly sensitive to global liquidity, central bank policies, and interest rates, not just those crypto-native catalysts like halvings anymore.
And that leads us to this really fascinating macro dynamic we call the Fed liquidity trap. While the Federal Reserve pushes this higher-for-longer rate policy to cool down inflation, sophisticated institutions are already looking 2 steps ahead. They are proactively buying Bitcoin ETFs as a hedge against future currency debasement, effectively front-running those central bank policy changes. Meanwhile, the trap closes on retail investors, who are just sitting comfortably in 5% T-bills or money market funds. They're slowly losing purchasing power to inflation and entirely missing out on the risk-adjusted upside.
Let's bring this all home with Section 5, Family Office Allocation Strategies. According to recent BNY Wealth data, highlighted by XBTO, a staggering 74% of family offices are now exploring or actively invested in digital assets. That's a massive, massive jump from previous years. The maturation of qualified custodians and these new regulated ETFs has effectively wiped out any lingering career risk for allocators. Honestly, for family offices managing multi-generational wealth right now, it is actually riskier not to have a thesis on this asset class. Depending on your specific mandate, allocations generally fall into 3 distinct buckets. Conservative offices are allocating about 1 to 3%, heavily favoring the operational simplicity of regulated spot ETFs, like IBIT or FBTC, just to entirely avoid any self-custody headaches. Moderate profiles bump that up to 3 to 7%, often mixing direct holdings with those ETFs. And your more aggressive, tech-forward offices, they're pushing into the 7 to 15% range, utilizing direct custody so they can capture staking yields and get deeper market participation. To make all of this super actionable for you today, here is a fiduciary execution checklist to take you right from theory to execution. First up, define your portfolio objective. Is it a hedge or for return? Next, get those board-approved allocation limits set in stone. Then, select your execution path, whether that's ETF or direct. Step 4 is absolutely critical. Strictly document your custody and insurance policies. Step 5, run some aggressive stress tests. You really need to know how the portfolio handles a 30, 50, or even 70% drawdown. And finally, review performance quarterly, not daily. Following this ensures you're treating it as a properly governed strategic position rather than just a speculative thrill.
As we wrap up this explainer, I want to leave you with a rather provocative thought. If Wall Street is out there actively front-running global liquidity shifts using Bitcoin, what is the opportunity cost of keeping your portfolio anchored in the past? The infrastructure is totally matured, and these playbooks are actively being executed as we speak. Can your fiduciary mandate really afford to ignore this new institutional reality? Thank you so much for joining me, and I sincerely hope you can apply these insights to your own strategic planning moving forward.